Akash, first of all, just given your history, I know you can comment on this as well. What's your take on sort of where global rates are in this fairly dramatic move we've seen of late in terms of yields?
Well, the move lower in rates, both in the U.S., but what we're seeing broadly across the OECD and emerging markets is clearly a bullish factor for gold. But it's not just nominal yields that matter. If you look at even in the U.S., real yields at the belly of the curve, if you look at the 5-year and 10-year sector, we're already approaching zero. And in that context, we haven't been there since 2016. And I think that's a very favorable environment for gold, which, I would model as a long duration, zero coupon asset. So gold is really benefiting from the central bank easing. Just one more point on the central bank side globally. It's not just that the central banks are cutting rates in this environment, but it's also the fact that the central banks are buying record amounts of gold. If you look in 2018, you saw over 650 tons of net purchases from central banks. That's a post-Bretton Woods record. In the first half of this year, we saw 374 tons. So we're already on pace to eclipse my 700-ton central bank forecast for net gold buying in 2019. So this is a very constructive environment, not only from a rates channel, but also from an official sector purchase channel.
And you would have made more money buying gold so far this year. Year to date, up 18.25%. That's more than the overall S&P 500. Just make the case to investors who are looking at the yield move and thinking, why wouldn't I just buy a Procter & Gamble or a company with a high dividend yield versus gold, which doesn't pay any yield?
Sure. So that's certainly a discussion among macro investors. When the S&P 500 is paying a higher dividend yield than a 10-year Treasury bond, where do you allocate? I think the concern is that a lot of what's driving gold inflows is not just lower rates, but what's driving lower rates is also concerns about global growth risks, trade tensions, and emanating from that standpoint. So you also are seeing a safe haven bid for gold and kind of a protection of your investment by having gold holdings in your portfolio. So basically, gold is also benefiting from risk-off flows amid these lower global rates, both in nominal and real terms.
I haven't heard you mention currencies, which is actually why I think that gold has been doing so well. It's the ultimate alternative currency. And when every central bank is now pressuring their own currency, 3 surprises overnight, China, I mean, you name it, gold gets the benefit of the doubt. What is gold price telling you about where monetary policy is headed and where currencies are headed?
Sure. So in this discussion, we've been mainly talking about gold denominated in U.S. dollar terms. But certainly, if you're looking at it across other G10 currencies, particularly risky G10 FX, such as pound sterling or Aussie dollar, gold is already at record nominal levels in those currencies. And in the dollar terms, we haven't seen a sharp sell-off in the dollar. It's been relatively range-bound over the last 3 months. You've seen a little bit of weakness in the big dollar index since the somewhat hawkish July FOMC. But in that context, gold is continuing to outperform. I think if the dollar is going to weaken over the next 6 to 12 months, I think through denomination effects, that's just a kicker for gold. Although I think in this environment, I think it's the rates channel, lower real yields, official sector purchases, and kind of safe haven inflows that are really driving a really strong bid for the yellow metal. To that point, I've highlighted, I guess, against consensus for the last few months that I don't think gold positioning is stretched long yet. We haven't reached Brexit peaks on the COMEX exchange. And from a normalized basis, looking at open interest, I think the market can still accelerate another 50 to 100,000 contract equivalent.